Hello, I decided to make this quick video following our conversation here in the Slack group, and I'd like just to show you how much easier it is when I can explain it with words rather than text on the chat and a chart, of course, in front of me. So this is how I would trade that based on Elliott wave theory. So here we have a special form of an impulsive wave, which is called a leading diagonal. 1, 2, 3, 4, and 5. This type of impulsive wave means that the internal waves of those 5 waves will be in a 3-wave structure: A, B, C, A, B, C, A, B, C. That should be A, B, C, A, B, C. So we can also, within such a pattern, we know that the Fibonacci relationship between waves A and wave C will be between 100% and 138.2%. Thus, when prices continue higher and we reach levels like the 161.8%, that relationship between this wave and this wave is more often between wave 1 and 3 in a normal impulse. But I don't want to get you confused. The point is that if prices advance further, this pattern will likely be incorrect. So given this information, that we have already reached the level at which wave A is 138.2%, wave C is 138.2% of wave A, we have already reached the target for this wave 3. Therefore, we expect a reversal from this level. And as we discussed in Slack, this also is confirmed, let's say not confirmed, also suggested by an additional pattern that Nazri showed in the Slack group, a bat pattern which also expects a reversal from this level. This is also an important support resistance level. We see here how prices interacted with this level. Here also, and so we expect around this level a reversal to occur. So we can easily short the pair at this level and put our stop loss level at this level here, because as I said, if prices continue that higher, it is more likely that this pattern is incorrect, so our Elliott wave analysis is incorrect, and it is a good point to exit that trade. So current prices are around 133.30, and this level here is 133.75, let's say. So we have 45 pips between current prices and our stop loss. And we're looking for a reversal and a target now for that reversal. We expect a 3-wave move, A, B, and C for wave 4. So we're looking for the first wave to the downside, and we're looking for an important support level to stop this decline. And that level, the first important support that I see below here is this level here, because this is the high of wave A of 3, this is the high of wave C of 1. It is also here an interaction we had back here. Also, we see that wave 3 of A found support here, and it managed to hold prices for quite some time here. So this is an important support level, and I would go short here with a stop loss here and a target here. So we're getting 45 pips here of risk for a potential profit of here we have 32.10 from 33.30, 120 pips against 45, which is a great risk-reward ratio. So now, let's say that the analysis is incorrect and prices drop further. So when we reach that level, we will exit our first trade with a profit. And this will be, excuse me, I'm gonna remove this. and I'm gonna remove this 2 in order to clear the picture. This will be wave A of 4. So we will be looking for a correction to the upside for a wave B. We don't want to trade corrections because they take multiple forms and they can be lengthy in time, and they're usually short in size, so there is no much profit potential. We don't want to trade, we don't want to be trapped into lengthy sideways moves. So what we're going to do once our target is reached, we will be monitoring the pair and prices by drawing a Fibonacci retracement tool from our top here to our low of wave A, wherever that is. And we will be expecting our wave B to find resistance at a Fibonacci level, around Fibonacci level, usually the 50% or the 61.8. But we also want to combine this with other levels of support and resistance, classical support and resistance. So for example, if this is wave A, as I drawn it here, okay, the 50% will be around this level. You see this level here and this level here, which is obviously an important resistance level. So once prices reach here, we sort the pair again, and this time we have a much more clear level a much more clear level to put our stop loss. That will be this high here, because if prices move beyond this level, this pattern is invalidated. Once wave 3 is in place, prices cannot move above it for wave 4. So we sort the pair around the 50% or around this level, between those levels here, and we set our stop loss here. That will be 32.70 for if the high is here, of course, for 33.30, 60 pips of risk here. And then we will be looking for a decline for wave C. Okay, this will be a wave C of 4. Okay, and how we will calculate the target for this decline, we have several patterns to look at here for a probable target. Okay, I'm gonna remove this now to clear up things again. First of all, we have this trend line. We want this trend line to be reached. Second of all, we have this support level, and here it was resistance. Okay, so this is a possible target, but this is dynamic, and therefore this trend line will be moving higher if prices get moving more sideways here. So aside from the static support levels and this dynamic support level, we will also be looking, as we earlier said, at the relationship between wave A and wave C. So we can use the Fibonacci expansion tool, trend-based Fib extension, it's called in this platform. And from this level, from wave B, okay, and we can see that around this level is the 138.2% of wave A. So around that level here we have a possible target for our wave C. So again, we have 60 pips of risk. For here we have 32.70 for a target at 31.30. So it is 70 and 70, 140 pips, about a little more twice than the risk we were taking. Again, a pretty solid risk-reward ratio. This is how I would approach trading this specific Elliott wave pattern. I hope this video makes helps you understand better what I was trying to explain earlier in the Slack group. Thank you very much for watching.